Welcome to Facts Not Forecast, your daily edge in the stock market facts, insights, and opportunities you won't hear anywhere else. Today, we are strapping into the cockpit for a deep dive on Archer Aviation, ticker ACHR. This one's given investors some serious whiplash just in the past few days.
Oh, definitely.
Archer has been on a roller coaster, right spiking on Tesla rumors, then crashing just as fast. So the big question is this flying taxi stock the real deal, or, just another hype cycle? We dove deep into the source material to try and get some context behind all this volatility.
Yeah, it was quite something just watching the ticker this week. Really exhausting. We're looking at a serious case of extreme market sensitivity here. I mean, think about it. If you happened to buy ACHR shares maybe a month ago, you'd be sitting on gains over 46.7%. And just recently, there was that 5-day surge topping 27%.
Yeah.
Huge moves.
Wow.
But then, bam, in just 24 hours, between October 7th and 8th, all that momentum just reversed. Almost instantly, the stock pulled back 8.5% after some, expected news didn't actually happen.
So not just turbulence, more like hitting an air pocket.
Exactly. Like a microburst event for the stock price.
And the trading volume, that really tells a story too, doesn't it? It seems like institutions and retail traders were all kind of colliding, panic and euphoria all mixed up.
Oh, totally. On an average day, you see maybe, 39.35 million shares trade hands?
Right.
Well, during that peak hype and then subsequent crash period, the volume just exploded, shot past 70.55 million shares.
That's nearly double.
Yeah, almost double the usual activity. It just shows how much attention and, frankly, how much serious money is scrambling in and out of this name right now.
So it really highlights that core tension, doesn't it, between the potential and the hype?
It really does. Because on one hand, you have what seems like a solid industrial mission, right? Archer, founded back in 2018, they're purely focused on designing and developing these electric vertical takeoff and landing aircraft eVTOLs.
Okay.
Specifically their main model, the Midnight. The goal is urban air mobility, or UAM, basically trying to make air taxis a real thing in cities.
Right. So let's maybe take a beat and separate the hype from the reality. What are the actual concrete achievements here? The non-speculative stuff? Because this isn't just some idea on paper, is it?
No, it certainly isn't. And that's important. We have several key milestones that show they're moving beyond just, fancy computer renderings.
Like what?
Well, the Midnight aircraft, their flagship, it's actually flown. It hit a record altitude in testing, and it completed a 55-mile piloted flight. These are major physical achievements for the tech. They validate the engineering approach.
A 55-mile flight. Okay. And how about the regulatory side? Because that's always the big hurdle with aviation tech.
Huge hurdle. But they've made some real inroads there, too. They've joined the White House eVTOL pilot program working with the FAA. That signals pretty deep cooperation, a serious push towards getting certified under, the highest safety standards.
That sounds significant. And production. Are they actually building these things?
They are. As of the second quarter of this year, 2025, they reported having 6 Midnight aircraft physically in production. So yes, that's real manufacturing happening, real momentum.
Okay, that sounds good. But let me push back a bit. A 55-mile test flight, joining a pilot program. That's all progress, sure. But is that really enough to justify a multi-billion-dollar valuation? Or are we maybe celebrating steps that don't actually solve the really big problems, like full FAA-type certification and then scaling up production affordably?
That's the crucial distinction, absolutely. And the sources suggest their answer to mitigating that risk lies in their institutional backing. The operational stuff proves the technology works or is getting there. But the partnerships, they aim to prove the commercialization is actually feasible.
Right, the partners. And these aren't small names. We're talking United Airlines, Stellantis. That's serious corporate muscle. Is it just about the money, or is it more strategic, like lending credibility?
It feels like a combination, honestly. United and Stellantis, they bring more than just capital. They bring deep domain expertise, right? Airline operations from United, mass vehicle production know-how from Stellantis. That should, in theory, speed up the whole industrialization timeline.
Okay, so it moves Archer beyond just being a cool tech startup.
Exactly. Puts them into the global supply chain conversation. And we shouldn't forget their defense sector involvement either. They're focusing on military hybrid VTOL technology, too.
Ah, interesting. Defense contracts can be a steady source of early revenue, can't they? A bit of a cushion.
Potentially, yes. It could insulate them somewhat from the immediate pressure of making consumer air taxis profitable right out of the gate.
And they're not just focused on the U.S., are they? I saw mentions of global expansion.
Astonishingly fast, yeah. They've announced partnerships in Japan working with Japan Airlines and Soracle, specifically aiming for air taxis in Osaka.
Wow, okay.
And then in the Middle East, they're collaborating with the Cleveland Clinic in Abu Dhabi. The plan is to set up the UAE's first hospital vertiport for eVTOL access.
So linking transport, tech, and even healthcare, they're really trying to validate this whole UAM concept globally.
They really are.
Okay, so that's the industrial side. Impressive momentum, lots of moving parts. But it still doesn't quite explain that wild stock spike recently, does it? That 27% surge and then the 8.5% drop. None of those partnerships explain that.
No, you're right. That story traces back to something much more, well, flimsy. The great Tesla rumor of October 2025.
Ah, yes, the Tesla effect.
Correct. We just watched speculative money pour in, seemingly because of a cryptic social media tease from Tesla. It involved some object that looked a bit like a turbine.
And investors just jumped.
Jumped to conclusions, big time. They figured it must signal either a partnership with Archer, given their profile in eVTOLs, or maybe Tesla itself getting into aviation. The whole massive stock move, driven purely by social media speculation, Twitter threads buzz.
That's kind of astonishing, isn't it? An 18% spike in a single day, adding hundreds of millions in market cap, all based on a tweet. What does that tell us about this whole urban air mobility space right now?
It tells us that even though Archer is fundamentally an industrial company built on complex engineering, the stock trades like pure sentiment. It acts almost like a barometer for market excitement about any disruptive tech.
So when Tesla's actual announcement came out and it was just about EVs, not planes.
Poof. The speculation evaporated instantly. The stock pulled back hard. It really showed how the market had confused that rumor-driven frenzy with some kind of real long-term conviction. It just wasn't there.
And we can actually put numbers on that risk, that sensitivity. The sources mention the stock's beta coefficient. It's incredibly high.
Jaw-droppingly high is a good way to put it, ranging up to 6.03 in some calculations.
Okay, maybe break that down. What does a beta of 6 really mean for someone listening?
Right. So beta measures how much a stock tends to move compared to the overall market, like the S&P 500. A beta of 1 means it moves in line with the market. A beta of 6. Well, to put it simply, if the whole market moves just 1% on a given day, Archer stock could realistically move 6% in either direction, up or down.
6 times the market move? Wow.
It makes it almost a pure leverage play on speculative sentiment. And then you add in the short interest. That complicates things further.
How high is the short interest?
It's substantial.
Yeah.
Hovering around 18.66% of the public float. That tells you there are a lot of traders betting against the stock. It creates a really divided market, prone to dramatic short squeezes if good news hits, or sharp drops if bad news lands.
Okay, so you've got a stock moving 3 to 6 times more violently than the market, lots of shorts. What happens when all that volatility slams into the cold, hard numbers, the financials? Let's ground this back in reality. What's the income statement actually look like today?
Well, the foundational reality is pretty brutal, but simple. Archer is pre-revenue.
$0 coming in the door.
Exactly. Trailing 12-month revenue, TTM revenue, is $0.00 million, which means price to sales is NA. There just aren't any sales to measure against yet.
And forecasts. Are they expecting revenue soon?
Analysts are forecasting some revenue, but not a lot relative to the valuation. For the whole of 2026, the forecast is only around $84 million.
$84 million on a market cap of what, nearly $9 billion?
Roughly $8.8 billion. Yeah. So while technically it's infinite growth starting from zero sales, $84 million is still, well, it's a tiny revenue figure for a company valued that high.
So that price to sales unavailable isn't just a technicality. It's screaming that this is all about future potential, not current business.
Absolutely. It's a pure capital expenditure story right now. The market is valuing the promise, not the profit.
And that promise costs a lot to pursue, right? What's the cash burn look like while they develop all this?
The cash burn is significant. The net loss for the trailing 12 months was a massive negative $612.80 million.
Over $500 million lost.
Yes. And forecasts suggest the losses might actually get worse before they get better. The projected loss for 2026 is around negative $737 million. Getting through FAA certification, starting scaled manufacturing, it costs a fortune.
Okay, so massive losses, zero revenue. But still, that $8.8 billion market cap, it feels really disconnected. How are investors justifying paying that kind of premium? What metrics are they looking at?
They're essentially betting the farm on the successful execution of UAM. They're looking years down the road. One metric sometimes used for pre-revenue companies is price-to-book ratio.
Right, comparing the market price to the company's net asset value. What's Archer's PB?
It's sitting around 4.8x.
And how does that compare to, say, the broader aerospace and defense industry?
The industry average is closer to 3.6x.
So paying 4.8 times book value means investors are paying quite a premium for every asset Archer owns, from patents to those 6 planes they're building. You're really not buying a piece of a current business.
No, you're effectively buying an option, a highly speculative call option that says, I believe this company will succeed, commercialize, and the whole UAM market will take off at scale. The risk is definitely reflected in that multiple.
But, and this is a crucial but, they aren't running out of money tomorrow, are they? That cash burn is scary, but they have a buffer.
That's their moat right now, that liquidity. As of the end of Q2 2025, Archer reported having a very substantial $1.72 billion in cash and equivalents on hand.
Okay, $1.72 billion. How far does that get them, realistically, when they're burning over $600 million a year?
It means they have a significant runway. Likely 2, maybe even 3 years, give or take.
Yeah.
Enough time to keep pushing on development, flight testing, FAA certification, without immediately having to go back to the market for more cash, which would likely dilute existing shareholders.
So that cash pile provides stability, a competitive edge against rivals who might not be as well funded.
Absolutely crucial. It buys them time.
And what about Wall Street analysts? Are they all bullish, or is there disagreement on how to value this mix of risk and potential?
Well, the overall consensus rating is generally positive, mostly buy or strong buy ratings. That sounds good on the surface. But look at the actual price targets. They are all over the place. The range is huge.
How wide are we talking?
The low estimate is down around $4.50 per share. The high estimate, $18.
Wow. From $4.50 to $18. That's not a forecast. That's not a forecast. That's basically throwing your hands up.
It's a massive shrug. Exactly. It tells you the analysts are essentially saying, look, this stock could be worth the price of a coffee or maybe pay your rent for a month, and honestly, we're not sure which. That huge spread just perfectly captures the massive uncertainty around the regulations, the technology maturing, market adoption, everything.
So, okay, let's try and synthesize this for someone listening. We've got these 2 very different stories playing out simultaneously, don't we?
We do. You've got this promising industrial company making real tangible progress on one side.
The flights, the partnerships, the FAA program.
Exactly. Real operational achievements, key partners like United and Stellantis, defense contracts, that stuff elevates it. It's not just a meme stock built on air.
But then you have the other side.
The other side is that because its massive $8.8 billion valuation hangs entirely on future hopes, not current dollars, it's incredibly sensitive to sentiment. It's vulnerable to those wild swings we saw with the Tesla rumor. The same volatility dynamics are absolutely at play.
So if you're looking at this stock, you really need to decide what kind of participant you want to be, right?
Precisely. For the long-term investor, this is the definition of a high-risk moonshot. You're betting that urban air mobility becomes a real mass market thing by 2025 or 2026, and that Archer leads the pack. It's a bet on the entire industry's future.
High risk, high potential reward.
Whereas for a short-term trader, well, this stock looks like a perfect storm for volatility plays. You've got that super high beta, the rapid sentiment shifts driven by news, or even just social media.
But incredibly risky to time those moves, especially with nearly 19% short interest waiting to squeeze or collapse.
Exactly. Timing those swings is a brutal, high-stakes game. You could get burned very easily.
So, thinking ahead, what's the next big hurdle? What's the thing we need to see happen?
Well, look, Archer has to make the jump. They have to transition from burning hundreds of millions of dollars every year to actually hitting those revenue targets analysts are putting out there. So the big question is, what operational milestone really proves commercial viability? Is it another flight test? Probably not. Another partnership? Helpful, but maybe not the key.
So what is it then?
Is it the first FAA-certified aircraft rolling off a real assembly line? Is it the first paying passenger flight on a commercially approved route? Is it scaling up operations in a city like Osaka or Abu Dhabi? Something needs to happen that clearly signals the shift from R&D burn to actual revenue generation. That's the commercial turning point everyone's waiting for. That's what ultimately justifies or doesn't justify the current valuation.
That really is the critical moment ahead. So would you take a seat on Archer's flight to the future, or is this just turbulence before a hard landing? Let us know in the comments. Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.